Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. I'm your host, Neville Hicks, alongside Christoph Barnett.
Good morning.
We have in studio with us Rich Ellison, who's been an avid supporter of Money Sense. Rich is one of the directors and founders of OneTradEx, an avid listener of Money Sense, I hear, and also a CFA charter holder. So welcome, Rich.
Thanks, Neville. It's great to be here.
Rich is also a CFA exam grader. So he is certainly next level when it comes to knowledge. So we're going to leverage that for our audience. We've got a great show lined up, and it's kind of bringing together a culmination of a lot of our discussions throughout, I guess, the last couple months, where we've kind of talked about different asset classes. We've had different people on from different industries in Cayman, whether it was hedge funds, and real estate and all these different asset classes. We're going to talk about how we invest through them, and also kind of some of the different risk characteristics about those asset classes. So I think where we start off is certainly two asset classes that we tend to know a little bit more about being here in Cayman. I think for most people, from an investment standpoint, it's what they would consider that they know, and that's real estate and I guess your traditional bank deposit. I guess passing it over to Christoph, what are some investment characteristics about real estate that are worth noting?
Well, I guess starting off with advantages, you can see it. It's easy to understand. You can visit it. You can see your name on the property title. It's yours. It's easy to get, relatively easy to get bank financing to purchase a piece. Mm-hmm. There's a ready rental market and a relatively liquid, depending on where you buy in Cayman, market to be able to buy and sell the property. So those would be the main advantages. I guess the disadvantages would be that it does take a while to sell sometimes. It may not be at the price that you want. There is a large commission that has to be paid. You might not get a good renter.
Both the government on the front end, and then I guess the estate agent, or
do it. Both sides, yeah.
Yeah, I mean the real estate agents get paid for their service on both sides of the transactions, unless you're selling privately, which reduces your market and may result in a lower price. So sometimes it probably is good to pay the agent to try and maximize your return on it.
Certainly.
I guess one other thing that I like about real estate is that it takes on some aspects of a private business, in that you can influence your returns. Like if you're renting a property, you can make it a better property by making some investment and then get a higher rate of return. Or you can choose a better renter somehow and get a better rate of return. So you can impact rather than just making an investment and waiting to get paid. You can actually take action to make it better.
You can enhance it.
Absolutely.
I mean, I think if you look across the different asset classes from an investment, I think real estate has two functions. One is there's the use of it, being, you can live there, but also, then having that as kind of more of your own kind of private equity investment. But I think the issue becomes, and you touched on this a little bit earlier, is what portion of your wealth should be in real estate. And we often talk about, home country bias. I know, Rich, you're from Canada originally. Home country bias is a tendency. I mean, I remember when I moved, also Canadian, when I moved down here, I used to think Canada was kind of the center of the world, or Toronto was the center of the world. When you go to find out it's only 3.5% of the world stock market. So you have a tendency, and I think that happens, and is true here with real estate to a certain extent.
Yeah, I think that's the case with real estate. I mean, I'm Caymanian, born and raised here, so I think just as a function of the investment opportunities, real estate is a big one in Cayman, and so for home bias, that tends to be our bias. It's not like we can buy a lot of Cayman bonds and stock and have a big exposure that way.
Well, I mean, with any real estate investment anywhere, if you're doing it in individual properties, unless you're truly wealthy, you've got a real concentration risk.
Sure, it's a big
because it's very hard to get a portfolio. Whereas, if you want exposure to real estate and the returns of real estate, you may be better off investing in a real estate investment trust, which could be multi-country or at least properties within one particular country. And to the best of my knowledge, I don't think we have any local REITs at this point.
I don't believe so. I don't, but it's not, it's not a bad idea, actually. Yeah. Thinking about it, giving people some exposure. I know there was some petitions, I think, for, some of the local pension funds to look at the port as far as a, kind of a group investment scheme. But yeah, that does raise a good point. I guess flipping to the other side of certainly an asset class we're quite familiar with, which has really the opposite characteristics of real estate, is your typical or your traditional bank deposit. And I think we all have access to banking here. We've got I guess to a certain extent some flawed characteristics within our local banking market, but we can still go get a term deposit, albeit it's not going to pay us anything. But what are some we traditionally think bank deposits are safe. Is that the case?
Well, it's I would say it's safe, and I don't want to cause any panic, but banks have failed in the past, and we just have to be aware that if a bank does fail, then usually depositors are what they call unsecured general creditors. Unsecured meaning there's no asset backing your deposit, and general meaning you're in the pool with everyone else. And so we can talk about how much allocation you should have to cash, but basically once you've gone beyond your sort of 1 year spending requirements, unless you have needs for that cash, it's time to look for other asset classes just to diversify yourself.
Certainly.
Yeah. Well, I mean, with any bank deposit, you're also looking at, sort of in our local market, if we look through over the years, we've had a couple of high profile bank failures, but for the, most part, it hasn't been an issue for most people. But certainly there's not much variation in the return characteristics that are paid between different banks. And as with any investment, it behooves the investor to take a look at what's underlying their investment and see if they think it's a fair return compared to something else where their cash might be a little more liquid or appear to be a little more safer because of the strength of the underlying balance sheet.
I think that's a great point in terms of looking under the hood, even at the bank itself, just because Cayman is different from other countries that have what's called deposit insurance, where a certain amount of balance is insured by a general pool or a government agency. Whereas in Cayman, will the government bail out a bank? Maybe. It's happened in various forms before, but there is that risk. And so I actually think, I believe in free market. And so if I know that my money is uninsured, I'm going to maybe be a little bit more careful which bank my money's in.
Yeah, certainly.
But it's safe. It's safe. No, it's liquid.
Safe is a relative term.
You don't make.
It's a very safe. Cash is a very safe asset class. And,
it's very safe.
I don't think any of us are suggesting that there's imminent bank failures waiting to happen in Cayman for sure.
No, but touching on that, we go through the financial crisis. That is, that's still, a couple years back. This forget Cayman. This is a global. It wasn't. This was a global phenomenon. We're seeing issues with, banks in Europe right now, banks in Italy.
Yeah,
this is not. I think the point is, it's worth.
Not even safety, but just looking at returns. If you have money that you need to use in 5 years for kids' college or whatever, start of retirement, then just from a return stream, you said it in the bank, you're getting very little returns. Right?
You're getting virtually nothing.
Yeah, that's our current. We've all sort of developed economies have moved towards kind of that Japan style, incredibly low return rate that we've seen for decades there, and there really is very little return on fixed income. And if we were to translate it into real rates, inflation is quite low at the moment, but there is inflation, and often your real return's negative if you factor in inflation to it. If you're just holding cash in there, which is the intention of the central banks right now, is to push you into riskier assets and things where you get a better return because they're still trying to stimulate all these economies, through monetary policy.
Certainly. I think that raises a point that we look at, that whilst bank returns are still low here in Cayman, but if we look at other countries, developed countries, for instance, Japan or Switzerland, just to name a few, we're actually seeing bank deposit rates that are negative. And I guess walk us through what that means for a customer at one of these banks.
Well, typically at the retail level, they've hesitated to charge negative interest. They might have a closet negative interest by calling it fees, which sometimes can happen here too. Although I have seen where, was it Germany, that if you had a deposit over 100,000 euros, they were going to start charging you rates, which again, it just reinforces our point that if you have short-term spending needs, don't put all your cash in the mattress, but if you need to spend it over the next few months, keep it at the bank. Even if it's negative interest rates in Europe, you'll get less money, but you'll have your money. And if you have a long-term spending need, move into other asset classes.
Certainly. I think that really brings us to, the other asset classes that we've talked about. And I think that a lot of our audience or people are less hesitant or certainly after the financial crisis are aware of but unsure of, which is really equities or stocks and bonds, fixed income. Then you go down the line with alternative hedge funds and private equity. So what are the methods to actually get an account open? Let's say I'm this person who's, I have my real estate, I have the sustainable debt on that. I've got my 1 year of savings in my bank account, and I've got some excess money around that I'm not earning anything at the bank. What are my options as far as, opening an account? Who's qualified to manage it? And I think there's two distinct methods. One is kind of more of a self-directed, and maybe I'll toss it over to Rich to just kind of walk us through what that kind of model looks like and who's appropriate for that, and some of the characteristics of those asset classes when we're looking at that.
Yeah. Well, I mean, if you're looking at accessing the equity markets, there's a couple of different ways to do it. One is self-directed, which basically is the investor making the choices and handling their own affairs, and then it moves along a sort of continuum of, getting advisory from somebody or moving to a discretionary account where there's an investment made and then somebody is managing it on your behalf. Now, the interesting thing about that is the more help or expertise that you're accessing, the higher the fees are, and also the bigger the initial hurdle to get into it. In the local market, you can get a discount brokerage account where you're going to trade online and do everything yourself without advice, which will be very low fees, and you can open that with a $5,000 initial deposit. As you move towards an environment where you're going to have somebody who's handling your account on an advisory basis, the fees are going to be higher because you have to pay for his or her time, and also your initial investment, you're probably going from, low six figures, and then the sky becomes the limit, and it's one of those things where, on a truly discretionary basis, you probably need at least $500,000 for somebody to take on your account and manage everything. There might be some other cases where they do it lower, and correspondingly, because somebody's devoting more time to it, the fees will be higher.
Certainly. We're going to take a quick break, but there's a lot to talk about here, and I think some further kind of insight as to what and who is appropriate for the various types and what you should be thinking about in both instances. So please stay with us. Welcome back to Money Sense. I'm your host, Neville Hicks, alongside Christophe Barnett and Rich Ellison here in the studio. Picking up from our conversation, talking about kind of self-directed, I think a lot of people have challenges with self-directed because they, it's kind of this big mystery box as to where do I start, or, do I need should I have a certain level of education in finance, or, should I be, just well read as far as papers, and, how do I know what stocks to pick? What are your advice to, or what would you recommend to someone who, is somewhat savvy of an investor or has, some experience on, taking the lead on a self-directed account? Where would you suggest they start?
Well, I think a couple of things just in your lead in there. That probably the most important thing is actually just starting. We're in a low return world, so if you can access, different asset classes that might get you a higher return, starting early and continually, putting that money away into something different than just a bank deposit on a monthly basis is a really good idea. We had a discussion, Christoph mentioned, people have this fear and they say, well, I'm not a financial expert, so how do I start or do anything? It's sort of like saying I'm not a doctor, so I'm not going to go and operate on somebody. But if we take that analogy, you can still do things to be healthy. You can eat better. You can learn about stuff. You can exercise. And certainly in investing, if you look at where returns come through, one of the most important is, asset allocation and trying to have a diversified portfolio. And there's a lot of resources out there, magazines, publications that we're all familiar with, Barron's and Forbes and things, online. And really you can reach quite a bit of the value of diversification and asset allocation with 3 to 5 ETFs, which are exchange traded funds.
Sure.
And most people are familiar with the concept of a mutual fund. They're still out there and they still work for some people. But, in the old days, we used to go in probably to our bank or an advisory group that was selling a product, and you could invest in a mutual fund, which is pooling your assets with a lot of other people so that you can spread them across and invest into a lot of things. And sort of the underlying problems with mutual funds were that they had to be managed, the fees were relatively high, and your liquidity was low because often you could, you had to decide what you wanted, say by the 20th of the month to subscribe, and once a month you could get in or out of the mutual fund.
So if you wanted your money out, you'd have to give a month's notice.
Yes,
type of thing.
to redeem. And if you wanted to put money in, they had to have it 10 days before they're actually making the purchases because it had to be allocated and structural things. And the exchange traded fund is essentially a mutual fund that's on a stock exchange, has a lot of the same characteristics, but with technology and how things have developed, it can be at a lower cost and you have intraday liquidity. If you change your mind, you could actually buy something in the morning and then decide at lunchtime, oh, that wasn't the right thing, I'm going to sell it and move into something else. Or, you can hold it and have it actively invested until, the last moment. You don't have to be pulling it out and waiting for subscription redemptions. And you can start out just with a general, ETF, S&P 500 gets you access to, 500 of the largest companies in the United States, which tend to be multinational, and you get a lot of global diversification just through that. The bulk of them will be names and then you can start and look after that. You might get a fixed income ETF to add in some of that asset allocation to, the fixed income classes. And if you do a little bit of research, you can find out which ETFs are for you. And one of the things is they have different characteristics, different costs involved in them. The more specific it is, probably the less liquidity the underlying ETF will have and the higher costs. Like I said, an S&P 500 one will be incredibly liquid and have lower costs. If you decide, water is going to be very important, there's a few water ETFs out there, but they're much smaller. They're very specific. The people running them have to do a lot of analysis to find good investments. And because of that, their management expense ratio, which is what you pay for them doing that on behalf, is probably 5 times as high as what you could get with say a Vanguard or State Street S&P 500 ETF.
Certainly.
But that's the easiest way to get into it, is to get a discount brokerage account and then look at a handful of ETFs. And you can do that with a little bit of research and homework on your part, but it's not that onerous that the average person couldn't do it after say reading for 3 to 5 hours.
Mm-hmm.
So I'm a self-directed investor. I open an account, which is sort of like a bank account process. I deposit my funds, and then just like I pay my bills online, I can go online, having chosen my percentages of how I want asset allocation based on my initial research, and buy those ETFs.
Yeah.
That's sort of a basic first start.
Sure. And then, you don't have to think about it every day. You have those holdings in there. You probably should do what's called rebalancing, which is moving things around to get back to your original percentages you mentioned, Christoph. At least every 6 months. Some people, if you have more assets invested, will do it every 3 months. And that's really, that's investing, and it's very similar to what people have done with other asset classes. And it's very different than this image of, if I get in the stock market, I have to be a trader watching it all the time, just doing things to try and really get ahead. You can invest and do things on a, sort of very deliberate basis. And, the CFA Institute research will tell you that, for the average person, the less you trade actually corresponds to higher returns.
So more of a buy and hold strategy.
Yeah, buy and hold, buy and adjust, or continued buying, so you can dollar cost average and get a nest egg that's building over time.
What are the disadvantages of being a self-directed investor?
You get back to sort of that level of expertise, and also, I think you guys may have had a show on behavioral finance before, but as people, we're flawed human beings.
Absolutely.
And there's news reports. There's just been a massive earthquake in Italy that's going to affect them. There could be a terrorist attack, any number of things, and often people, they may have read somewhere that you shouldn't react quickly or something, but when we're hardwired evolutionary when bad things happen to react to it and want to do something. And often when it comes to investments, we can see it, bad things happen and then people sell. And Warren Buffett would tell you, when bad things happen, you maybe should be looking at buying, right? Mm-hmm. His favorite line is, be fearful when others are greedy and greedy when others are fearful. And, it's worked out pretty well for him.
Certainly.
But, controlling your own emotions and your tie-in is one of the big disadvantages to being on your own and not having, somebody there. And that's why some people feel much more comfortable getting a relationship with a good, qualified and accredited advisor and, paying the fee for that, because there's somebody else involved in it and you don't feel like you're, this lone person trying to make all the decisions on your own.
Well, so you touched on a lot of things there. I think let's move into that managed space. You mentioned qualified. You mentioned fees. Let's touch on all that. So let's start by qualified. What's a qualified investor? What do I look for someone to manage my money?
There's a number out there. Obviously, I'm pretty biased in favor of CFA charter holders.
Same here.
So are we.
It's it's a very rigorous program, and it also is one that has a core. Of ethics is very important to the CFA Institute and to CFA charter holders,
and I think the industry globally.
Yeah,
and
and that's one of those ones where, you can look up and see the code and ethics that the CFA Institute has out there and that the charter holders follow. There's other things. If you're getting into private equity, Neville touched on earlier, you've got Kaya, the Chartered Alternative Investment Analyst designation. You've got certified financial planners. People from different jurisdictions. A lot of advisors in Cayman actually have gone through the Canadian Securities course and experience. And you're going through and you're going to have to do a little homework and see what people have and what it stands for. But with all these major bodies, that information's out there, and you can find out what it is. And certainly, letters behind someone's name, where you can check up and see that they're in good standing with an institute or body somewhere, is better than just somebody who your cousin has had good experience with, but you're not really sure where they gained their knowledge and how they do it.
And in terms of fees, I mean, we all know luxury goods have higher prices. So if I get the highest price advisor, is that the best advisor?
I think what you have to look at whenever you're doing something is who's the best person for you and how is the relationship going to go. And necessarily, spending the most isn't going to get you the best outcome all the time. But we do have a market and there's competition in there. And for the different levels advisory, I'd have to ask a real question if the average person is charging, 1.5% or 1% of assets under management for a certain level, mm-hmm. and then there's somebody providing the same service, but they want 3% plus a 75 basis point custody fee, I'd really want to kick the tires and see what differentiates that person and what makes the fees, because that extra 2% is going to hurt your returns every year in, out.
Mm-hmm. And I guess there's other things to think about in terms of layers of fees, right? Because there's the sticker price, and then we just touching back on self-directed investment. The costs that you're paying there are the trading costs, the cost of execution. Well, the manager has to pay those too, so the advisor fee is on top of that.
Yeah, it's always, even if somebody says, "Oh, it's an all-encompassing fee," you can figure out what the trading profile would be like. Their execution costs are generally going to be the same no matter where it's done, and your advisor or managed account still has to execute. If they're a really big shop, they may be able to access lower rates than you can as an individual, mm-hmm. but it's still going to be higher because you really do need to pay people for their time and expertise if they're working on it.
Yeah, certainly. I think just wrapping this up, I mean, I think we could go on here for about another hour, but unfortunately we're getting to the end of the show. I think there's good and valid points, for both situations, whether self-directed or directed using a qualified advisor. I think it's I think for our listening audience, I think it's a discussion that you need to have with your friends, family, people that you trust, to figure out kind of what method works for you and what you're comfortable with ultimately, and kind of your level of education. There's also important characteristics of different asset classes we touched on, and we'll hopefully carry this discussion over to a future show. But Rich, we wanted to thank you for joining us. I think it was very insightful. Christoph, as always, thanks. And for our listening audience, the CFA Society Cayman has got a Cayman Investment Forum. It's our 4th annual investment forum coming up in October. The website is caymaninvestmentforum.com. Please check it out. We have some fantastic speakers coming down here, and it'll be a fantastic afternoon. Also, follow us on Twitter at Money Sense Radio. And thank you for joining us this week. And as always, have a great day.
Money Sense is brought to you with the support of OneTradEx.